This is a Forex Mastery class, Series 4B, where we learn how to earn free Forex money with ease. So I want you to pay close attention so that we can actually develop a background or foundation that we laid in the previous section on this topic, liquidity zone and manipulation. Thank you. In the last section, we looked at liquidity, and we are able to understand that liquidity zone are zones where we have clusters of orders, and where we also have high volume of activity, price magnets, and you see buyers or sellers gravitating towards a particular zone or region. So those regions are the regions that characterize the liquidity zone. All right, so we looked at equal lows. So when you have equal lows in the market, and then you begin to identify them as level of liquidity, or you begin to identify them as liquidity zone. For instance, this one here is showing us where the people have put, where the traders have already put their stop loss. You can see where the dollar is written here. This is where people put their stop loss and they are looking to buy. But what happened is that smart money comes to grab that liquidity, all right, and then sweep past it, then mitigate the next other block, and then use it to buy eventually. So this is what we call equal low liquidity. We also have what we call equal highs. So it's just the reverse. So in the equal highs, you see that we have order being placed here. People place their stop loss here, okay, and then they are trusting that the market will come down, all right? So, but you see that eventually market actually try to pretend as if it will respect that level, but rather it later sweep through that level, all right? It grabbed the liquidity there, took all the stop loss, and then what did it do? Mitigated the next other block above the swing high, then come down to do the main sell. This is the characteristics or the actions of the big banks and the financial institution. This tends to play on the psychology of the retail traders who are looking at the market from just a lean view. So for you to really enjoy this concept, you need to look at the market at a broader view by approaching it like the banks or like the big financial institution. All right, so we're going to be looking at some examples where you would be able to see how this plays out in the real market. Okay, so for equal lows, we have this Australian dollar, New Zealand dollar, 30 minutes time frame. And you can see that we are trying to identify our liquidity zones. Here, we have been trying to work on these, and we have been saying that we're having what here? We're having a kind of sell-side liquidity, all right? And then we are having some equal highs here. But eventually, this played out, this other blocks played out, which was marked. And then we have this break of structure. Then we have this low, break of structure, another low, making an equal low. So you can see that. So this is obviously playing out just as we have here, equal low, and then the market does what? The big boys in the market comes to sweep this liquidity, breaks people's stop loss, okay, mitigate the next other block, and then what do? They buy and swing high. So that's what you should be looking out for in the market. Don't just jump into every market. Try to understand what the big players are doing. Try to identify the key levels, identify where you have your equal lows so that you can wait and allow the market to take it out, and then you can join at the next other block. I would rather say join at the next institutional other block, which will have marked out, just like we marked it out already from the bigger time frame that we streamlined down to 30 minutes. So you can see here. So by the time it got to that other block, it respected it, after sweeping out the liquidity, and then it eventually buys. Okay, so just like I said, that's our equal low. So always look out for these characteristics. When you look out for these characteristics, you will be able to avoid huge risk or losses in the market. So equal lows would play out, and then the market will sweep it, and then from there you can then come in when you notice a kind of reversal to make you what to buy if you're in the uptrend. Thank you. Next, we are going to be looking at is we want to look at equal highs, and then we'll see how we can identify liquidity and then how we can come in. So for equal highs, you see that like the diagram we have here in the theory, you see that people place their stop loss here, and the market makers try to, break through it by taking out the liquidity, move to the next institutional order block, and then sell. So that's exactly what we have here too. You see that this is high, this is lower high, this is lower low, this is another higher low, lower low. So when the market is doing this type of market structure, you understand that there will be places where liquidity or equal lows or equal highs might be showing. Like here now we have equal lows here, but here we have equal highs. And then during this equal high, you can see that the market actually comes and then break through the equal high into the next other block, which is this, tap into it a bit, and then sell. In the second place too, you see here that the market tries to make another equal high, one here, and we are seeing that there could be possibility for another equal high coming up here to make it a point of reference for retail traders who are going to be trusting that the market will be coming down. So they will be placing their stop loss around here, which makes it to have clusters of orders, clusters of stop loss, price magnets, where people are believing that maybe it will hold. But then what happens? It builds up liquidity, it builds up money for smart money to take them out, move to the next other block, and then sells. Being the second part of our topic, we want to look at manipulation. Okay, so what is manipulation? So manipulation occurs when you see something like this in the market. You see the market trying to make a story, and here you could have accumulation, and then you are seeing that we already have our roof. This is a key zone where we have supply, and then we are trusting that the market is going to come down and begin to sell. But then what happens after the accumulation? We have a kind of a manipulation, perhaps during Asian section. All right. So what happens is that the market tries to take out everyone, believing that the market would do is sell around here. Most of them have put their stop loss here because this are equal highs. All right. So there, market maker comes here, manipulates by taking out all the equal highs, and then drops a little, and then go back to respect that level that was actually not respected before due to manipulation during the Asian section. All right. So the market then comes here now and then identifies the institutional fair value gap and then sells at that place. There's something I want you to pick here. When the market is trying to do this, all right, we term this manipulation as what? Stop hunt. So the market is trying to hunt you, or should I say the institutional traders are trying to hunt you, that they know that you would want to sell here. So they hunt your own stop loss. And then like hunters, and then they try to take you out first. So manipulation can be deemed as stop hunt. So what do you do? How do you actually handle market manipulation? You have to understand when you are seeing, you have to understand the behavior of the market makers, or shall I say the behavior of the banks and the big financial institution. Whenever you see a key level making equal highs, and then you are trusting that to sell, do not just jump in. Watch out for this type of stop ons. Watch out for certain stop ons, all right, where you can actually see if the market is trying to do reversal. Now, how do you notice if market is doing reversal? You look out for things like shooting star, all right? This is a shooting star, all right? This is another one. This is a doji giving you an indecision, but followed by a shooting star with a big body, all right, and a small wick. So this is more or less engulfing these other candles, and then that is actually telling you that this market has completed the stop hunt and will want to come down. So in the next section, we are going to be looking at steps for trading stop hunts. All right. So the first step in trading stop hunts is for you to identify. So you have to identify the key levels, the key areas they are likely to have the stop hunt. All right. So you look for swing highs or swing lows. Also look for psychological levels in the market, just like we showed you. All right. So when you look for those kind of swing highs, swing lows, you can be able to understand what the market is doing, and then wait for the stop ons to occur. Then the next thing is you should confirm. All right. So allow the stop on to occur, and then you wait for price to reverse before entering. Then lastly, set logical target. This is where you aim for the next liquidity pool when you can make your take profit. So thank you. Just like we showed you in our example, if you're following, you will see that this place here is a place where we are trusting that our zone is going to sell, okay? But then it's doing accumulation for now, and we are waiting. So what I'm supposed to do is to actually allow the market to do a reversal before you go in. So if the market is not doing a reversal here, and I'm seeing hammer here, so I'll wait. After this hammer, is the market shooting up or coming down? I'll allow this candle to finish. Most traders trading based on candlestick Bible theory or concept would say at this place they are trusting that the market would, that they are expecting the market to sell, and they now see an hammer. All they do is that they wait for the hammer to complete and wait for the next candle to also form. So that this next candle is one that will tell you if this market is actually going to sell or is still enjoying its last buy. Okay, so but what we see is that the market is still enjoying the last buy. Okay, so that is the market manipulation. That is what we call the stop hunt. So you allow it to finish. When it finishes, then you look out for the reversal, and then you do what? You can come in here, or rather, I would like to wait to see what story the market is saying. So if you miss it around this place, then you come back and look for your institutional fair value gap, which is our imbalance. So you come in at this point, and then you put your entry here, your stop loss here, and then you can what? Make your sell. So thank you for your attention. Kindly subscribe to this channel and sign up to our link, all right? So that you can get your $100,000 demo account for learning. And then you can also get your 100% bonus on your live account. Thank you. Share the link and then like and subscribe. You can also drop your comment in the comment section. I'll see you in the next episode.